They told you to start an SIP or go with a lump sum. Just let compounding do its magic. But here's the uncomfortable truth. Most investors who follow that advice never build real wealth. Not because compounding doesn't work, but because they were never taught how it really works. This is part 1 of a brand new series on SIP lump sum investing and the real math behind compounding, and it all starts right here. He was 39, with nothing saved. Not because he was reckless, but because life got in the way. A kid with asthma, a job lost during a merger. Every time he thought he could start saving, something more urgent stole the spotlight. Then one night, sitting at his kitchen table, he Googled, "Can I still build wealth if I start late?" The answer everyone gave? Just start an SIP, let compounding handle the rest. So he did, every month without fail. But after 7 years of discipline, he looked at his returns and felt sick. It wasn't enough, not even close. That's when he realized compounding wasn't broken. The strategy was, if you've ever wondered why your money isn't growing fast enough, even though you're investing, hit that subscribe button right now. Because in this new series, we're tearing apart the textbook advice and rebuilding it with clarity, strategy, and power. So, what exactly is the lie behind SIP and lump sum compounding? And why do even the most disciplined investors get it wrong? Let's kick things off with the first big insight, and it's going to sting a little. For years, financial gurus have sold us a comforting idea. Just start investing. Pick SIP if you're consistent. Go with lump sum if you have savings. Sit back. Let compounding do the heavy lifting. It sounds logical, mathematically elegant, emotionally soothing. But here's the harsh truth. Neither SIP nor lump sum compounding guarantees wealth, unless you understand how timing, structure, and cash flow align. Most people are never told that. Let's break it down. SIP, or Systematic Investment Plan, feels safe because it's automatic. You drip feed money into the market every month. But if your monthly investment is small and your returns are mediocre, compounding becomes painfully slow. You're not building a snowball. You're collecting ice chips. Now flip to lump sum. People assume dropping a big sum in at once will lead to explosive growth. But if that money lands during a market peak, you're stuck watching it bleed. Compounding doesn't work if the base gets crushed early. Here's the real lie. People think compounding is a formula, but in reality, it's a system. And systems require alignment. Cash flow, timing, return rate, reinvestment discipline, these must sync. But most investors only focus on where to put the money, not when, not how, and not why they'll get the outcome they expect. So what's the lesson? SIP and lump sum are just vehicles. Without understanding the engine behind them, compounding structure, you're just hoping the road will slope downhill forever. Spoiler, it doesn't. Let's keep going. Now that we've exposed the lie, it's time to look deeper into why so many investors follow this advice blindly, and the psychology that keeps them stuck. Let's talk about something uncomfortable. That moment when you're doing everything right and still falling behind. You set up your SIP, you made your lump sum deposit, you avoided panic selling, you followed the rules. And yet, your wealth graph barely moves. You start to wonder, is it me? Is something broken? But here's the truth, you're not broken. The system is incomplete. Most investors fall into what we call the obedient trap. You follow the prescribed behavior, monthly investing, holding long-term, staying diversified, and you expect success, because that's what the books, the banks, and the influencers told you. But compounding doesn't reward good behavior. It rewards leverage, timing, strategic positioning. Without those, you can be the most consistent investor in the world and still struggle to beat inflation. There's a quote from Naval Ravikant that hits this perfectly. Play long-term games with long-term people. The returns in life come from compound interest in money, relationships, and reputation. But most investors only focus on one side of that quote, the long-term game. They forget the people, the positioning, the principles. They treat investing like a savings account with a prettier name. Here's where it gets dangerous. The longer you stay in this obedient cycle, the harder it is to question it. You've built habits. You've automated transfers. You've told yourself, this will work, eventually. But without strategic growth, that eventually becomes a silent trap. 10 years pass, and you're just now realizing you weren't compounding. You were just contributing. So let me ask you directly. Have you ever felt like you're doing everything they told you and still getting nowhere? Because if the answer is yes, you're not alone. And the fix is not more discipline. It's better design. Let's switch gears now. We've talked about the lie. We've exposed the psychology. But how do you actually make SIP or lump sum compounding work, even if you're starting small? By the way, if you're enjoying this video and want this series to continue, drop a quick yes in the comments so I know you're with me. All right, let's move into the real math behind compounding and why small amounts often fail. Here's a reality check nobody likes to say out loud. Small contributions and modest returns will not make you wealthy through compounding. That sounds harsh, but let's walk through the numbers. Say you invest $200 a month in an SIP for 20 years. At an 8% annual return, you'll end up with around $118,000. Now that's better than nothing, sure. But can that fund your retirement, replace your income, build generational wealth? Not even close. What most financial influencers fail to mention is that compounding only creates explosive growth when three things are present: a long timeline, a high return rate, and meaningful contribution size. Remove anyone, and the entire outcome collapses. Now take Lumpsum. Imagine you dropped $20,000 into an index fund. 10 years later, at 8%, you'd have about $43,000. Better, but still not transformational. Why? Because compound growth depends not just on time, but scale. And scale doesn't just mean large sums. It means reinvesting consistently, expanding your capital base, and timing your entries to reduce drag. Here's the real math lesson. Compounding works like a multiplier, not a miracle. If your base is small, your multiplier amplifies little. If your base is large, it starts to look magical. So if you're relying on SIP or one-time lump sum deposits to carry you, without increasing your earnings, without reinvesting windfalls, without timing your entries intelligently, you're not compounding. You're just contributing on autopilot. Let's break it down further. In the next lesson, we'll explore how wealthy investors engineer compounding, not through hope, but through structure. Here's what most people miss. The wealthy don't pick between SIP or lump sum. They use both, but strategically, not automatically, not blindly, not because a bank said it was a good idea. They use SIP to stabilize and lump sum to strike. It's not either or, it's engineered. Let's start with SIP. The average investor uses SIP like a subscription, fixed amount, fixed schedule, zero adjustment. But the wealthy treat SIPs as flexible cash flow optimizers. When income spikes, they increase contributions. When markets dip, they redirect more capital. They track return drag, liquidity impact, and real-time reinvestment opportunities, not just set-and-forget rules. Now let's talk lump sum. The average investor throws in a big amount once, often at the wrong time, and then waits. The wealthy? They deploy lump sum only when three variables align: capital surplus, valuation window, and liquidity leverage. That means they don't just invest because they can. They invest because the moment is right. And here's the kicker. Once the wealthy deploy, they don't wait passively. They recycle returns. Gains from asset A are rotated into asset B. They layer opportunities. They compound the compounding. That's how $100K becomes $1 million, not from a graph, but from a system. $1 million. So if you're still asking, which is better, SIP or lump sum, you're asking the wrong question. The wealthy ask, how can I build a structure where both serve a purpose without letting either control me? Let's keep going. Now that we've seen the structure, let's look at how timing and market cycles quietly destroy or accelerate compounding outcomes. Let's say you invested $10,000 in a lump sum during a market peak, right before a correction. Sounds unlucky, right? But here's the truth. That one moment of poor timing can set your compounding efforts back by years. And if your only move is to wait it out, you've already lost time, the one thing compounding needs most. Timing isn't everything, but it matters more than people admit, especially for lump sum investments. When you enter at a high, the growth of your capital base stalls while the market catches up. And since compounding builds off the capital base, not just your courage, you can end up spending years climbing back to where you started. That's not investing, that's financial rehab. Now contrast this with smart timing. Let's say you drop that same $10,000 into a fund after a market dip, when the NAV is lower and the potential upside is higher. That one move accelerates everything. You get more units, higher long-term returns, and a faster compounding engine. This is why the wealthy often wait to deploy capital, not because they're scared, but because they're strategic. Here's the trap. Most financial advice says, time in the market beats timing the market. True, if you have decades and zero urgency, but most people don't. If you're working with limited capital or a shorter runway, timing isn't optional, it's leverage. Let's switch gears. What happens when you start late and don't have perfect timing, perfect income, or a huge capital base? Is compounding still possible? Yes, but only if you rethink the time factor itself. You've heard it 1,000 times. Start early. Time is the most powerful force in compounding. But here's what they don't tell you. Time only works if everything else is aligned. Otherwise, it's just a longer journey to an underwhelming result. We've glorified the early start myth. But what if you're 35 or 45? What if you just got control of your income? Are you doomed to average returns because you missed your 20s? No, because compounding isn't just about time. It's about how you use the time you have. Here's the quote that flips the script. Albert Einstein famously said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." But most people think understanding it means starting early. In reality, it means using your time intentionally. If you start late, you don't need more years. You need more leverage per year. That means front-loading contributions, reinvesting aggressively, cutting unnecessary cash drag, and using every bonus or windfall as rocket fuel. It's not about 40 years of slow burn. It's about 10 years of engineered acceleration. This is why many late starters outperform early investors who coast. It's not because they had more time, it's because they did more with the time they had. So let go of the guilt. You didn't miss the boat? You just need a faster one. Let's break it down even further. The next lesson is about mindset, because compounding isn't just a math problem, it's a belief system. Most people treat compounding like a financial spell. Say the right numbers, wait the right years, and boom, wealth appears. But compounding isn't a spell, it's a practice. And the people who win with it think differently from day one. We've been conditioned to believe that compounding is passive, that once you set up an SIP or throw in a lump sum, the rest just happens. But ask any real wealth builder, and they'll tell you, compounding is a mindset, not a feature of your brokerage account. Here's what that mindset sounds like. Every dollar I invest must either multiply itself or increase my ability to earn. That's the core idea. Compounding isn't just about money. It's about effort, skill, focus, reputation, energy. People who compound fast don't wait for good years. They create systems that produce more value per unit of input. That's what wealthy investors do with capital. Entrepreneurs do it with cash flow. You can do it with SIP or lump sums, but not if you're treating them like chores instead of levers. Let me ask you, when you invest, do you feel like you're stacking momentum or just checking a box? Because the answer to that question will determine your future more than your return percentage. The mindset shift is this: compounding rewards those who reinvest everything, not just financially but mentally. If you keep showing up smarter, more intentional, more aware, your results will scale. Let's wrap this up. You've seen the myth, the mistakes, the real math, and the mindset. Now let's put it all together in a simple plan. One you can use starting today. If you want compounding to actually work, especially in 2025 and beyond, you need more than discipline. You need design. Here's what that looks like. Step 1. Treat your SIP as a dynamic engine, not a fixed subscription. Adjust contributions with income. Double down when markets drop. Think of it as your consistent muscle, quiet, reliable, but capable of lifting more as you grow stronger. Step 2. Stop fearing lump sum. Use it strategically. When you receive a bonus, a windfall, or close a deal, don't wait months wondering. Have a framework ready. Is the market undervalued? Are you holding dry powder for moments like this? That's how you use capital intelligently, not emotionally. Step 3. Track your reinvestment rate. This is the secret sauce most never talk about. Wealthy reinvest faster and more often than average investors. Every gain becomes fuel. Every interest payment becomes ammo. That's compounding at its core. Not return rates, but return velocity. And finally, don't treat this as a one-time decision. Make compounding your operating system. Revisit your strategy monthly, zoom out quarterly, adjust annually. The wealthiest investors don't make one big bet. They refine over time. So if you've ever felt like compounding failed you or that SIP and lump sum weren't enough, now you know why. And more importantly, now you know what to do next. This is just episode 1 of our new Trip to Wealth series on SIP, lump sum, and compounding. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.